Hey everybody, welcome back. So I am back today with another stock strategy options that will make you a ton of money with just so very little cash. And I'm always so excited about these stocks because typically these are stocks that you don't want to have long term in your portfolio because they're trading so sideways and they're really not moving anywhere. They're these stubborn little brats that just won't go up or down or whatever. So, but with these kind of stocks, there's a stupendous strategy that will just land you a lot of money with very little capital. Okay, so I'm gonna go right into it. The stock ticker that I'm looking at today is stock ticker IVZ. Okay, so Invesco. Okay, we don't really care too much about what the company does. Well, we do care a little bit about making sure that this is a legit company and that they have a pretty good market cap. So that way that there's plenty of liquidity. There's plenty of people selling options. But we don't really care so much as to what the company actually does. But if you're curious, it's basically an American independent investment management company headquartered in Atlanta, Georgia. Okay, so just taking a quick look at the charts. Let me show you how sideways it's been moving the last year or so. Okay, so the last 6 months, right? It's actually been down quite a bit. But if you take a look at the charts, from August all the way to December, okay, especially more so in November, December, it's really been trading around the $23 mark to 22, 22, 23. And so for several months, it was actually trading around $24. So I think this is when you could have made a ton of money using the strategy. And I'm going to show you exactly what the strategy looks like using Robinhood. So it's really easy to understand. But yeah, as you can see, this stock has been trading relatively sideways. But we do still want to take a look at some of the fundamentals to see and to gauge, if it would either go up or down in the upcoming weeks, and that'll help us, strategize our trade a little better. Okay, so taking a look at the Yahoo Finance, I love taking a look at the Bollinger Bands to really see the moving averages. And as you can see, right now the Bollinger Band is trading well below the moving average. So that basically tells us that the stock is eventually probably going to move back up towards the average. And so that just gives us a pretty good indicator as to how to set up our trade later. Okay, and one more thing I like to take a look at is finviz.com to look at the RSI. RSI is 41.26, so it's slightly oversold. And so we're not really interested in the other fundamentals as we normally do, just because, yeah, we're not trying to hold the stock long term. We're definitely trading these options in the short term. Okay, so going back into our Robinhood account, I'm going to show you how to set up this trade. So we're going to go ahead and first start out by, and typically people ask me, why do I do essentially the same strategies for all these stocks? Well, because I like to keep it simple, right? As people might say, like some people might have a ton of different strategies, but if you're accustomed to a couple of different strategies that works, then just stick with it. Okay, so we're going to start by selling a call, and we're going to sell a call right above the strike price, and then we're going to go ahead and buy a call above that strike price and below that strike price. Okay, we're going to customize our sell option to selling two calls instead of one call. Okay, now as you can see, our max profit is $92 with our max loss at $8. Okay, so we're risking $8 to make $92. That is an insane amount of profit, right? If the stock essentially goes up, we still make a profit. If the stock goes down, we still make a profit as well. And keep in mind, you can adjust this a little more. If you want to go a little further up, that's totally fine. So let's say I want to sell a call at 55 and I would buy the strike price above and underneath that still. I'm going to show you what that looks like when you sort of adjust a little bit. So we sold the 24. Okay, so So now, as you can see, right, you're kind of leaning more towards the upside. That allows the stock to move up, and you will still be risking only $25 to gain $75. Okay, so if you think the stock has more upside to go, then you can adjust the trade a little bit. Okay, so that's basically called the butterfly trade. I'm gonna do also an iron condor. Iron condor is essentially a very similar trade for stocks that trade sideways. It just allows you more room for error. Okay, so it's just more rooms for the stock to go and for you to profit. Okay, so we're gonna start out by and keep in mind the expiration date whenever you open up these trades is you wanna open them up as early as close to the expiration as possible. I could have done December 17th, but I think that's a little too soon. So with this stock, they unfortunately only have just options every January, April, June, so every quarter. But we're gonna go for a January one, and I'm gonna show you what the iron condor looks like. So we're gonna start out by selling a put credit spread. So we would buy a put. So we would sell a put underneath the share price, and we would buy a put underneath that. Okay, so to make sure it's covering the put that we just sold. Okay, so typically that's already a pretty good trade. Honestly, if you don't think the stock's going to move below 5%, then this is a pretty safe trade. That means you're going to make $28, but you're still risking $72 in case the stock drops to 6% more. You're going to start losing money. But in my opinion, I don't think the stock. Well, actually, I don't really know the company well enough to know if it's going to drop another 6%. But it seems like the stock doesn't drop that much. But anyway, so that's the put credit spread. And then we're gonna go into the call side of things, and we're gonna go ahead and buy a call, or we're gonna sell a call first, immediately above the share price, and we're gonna buy a call to cover that above that strike price. Okay, so now we get this little plateau, and if the stock goes down with 7%, you're still making a profit, which I don't think it is going to move that much down. But if it goes up to 3%, you're still making a profit. Okay, so that just gives you a lot more room to make money. If it stays kind of within the 1% and then the negative 4% range, and you're gonna make $75 off of risking $25. Okay, so you're risking $25 to make $75. You can adjust this little if you're more bullish on the upside. So let me show you what that looks like. Let's say you want to allow more room for the stock to go up a little more, so you can buy a put at the strike price immediately under, and then you can sell a put above that. And then when you go into the call side of things, you can go you can just go above where you sold your put credit spread. Okay, so that allows for more room on the upside and less room on the downside, and you're still only risking $35 to make $65. Okay, so I think honestly for me, because the Bollinger Bands and moving averages, as we were looking at earlier, seems to be telling us that it's probably going to go on the upside to move back to the moving average. I would probably open up this trade, and you're essentially almost doubling your money off. You're doubling the money that you're risking. You're risking your money on, so you're making $65 off of risking $35, and I think that's a really really great trade. Trade off for the amount of money you're risking. Okay, so if you like this content, if you want me to make more videos like this, just make sure you smash that like button, subscribe, comment below if you have any questions. I'll be more than happy to help. If you want me to just make more videos like this, I'll be more than happy to. Until next time, guys, stay safe, and I'll see you guys in the next video.